Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm having a conversation with the Director and Senior Market Strategist of Longview Economics, Harry Colvin. Harry, welcome back to Livewire. Welcome back to Australia. It's great to see you again.
Thank you for having me.
You've titled your latest presentation 2026, the year of Goldilocks, plain sailing, ? Why have you framed it that way? What are the elements in the backdrop?
Yeah, well, I think we've got a lot of features, Goldilocks type features in this global and indeed this US economy. And they include, I think, disinflation. Disinflation is a pretty dominant theme. It's playing out, particularly if you look at the service sector inflation in the US, but it's actually playing out around the world. And it's encouraging looser policy from the Fed and other central banks. You've also got a capex boom. And with that, an emerging phase of strong productivity, let's call it that, maybe a productivity boom. So loose money, strong growth from capex, AI adoption and productivity. What more do you want from a Goldilocks scenario?
It's a pretty good ingredients. Just talk to me there a little bit, Harry, about the productivity element. Is that very early stage? Are we just starting to see the green shoots of that productivity boom, potentially?
Yeah, it's difficult to know, isn't it? Productivity is one of the most difficult things to forecast. And it depends a little bit on how quickly and how broadly AI is adopted across industry in the US and in the rest of the world. But it's clearly happening. You know, businesses are starting to take on digital employees now that turn up in meeting rooms and they ask questions on Zoom and you wouldn't know they were there. And so AI is happening. It's being adopted and it's displacing labor, which I think is a really key theme. But yeah, that's a key part of the productivity boom.
Yeah. Let's shift focus, Harry, to equity leadership in the US. It's broadening beyond US mega cap tech. Interestingly, we've just completed our reporting season here in Australia, or close to completing it. And our banks and miners, which, you know, at the top end of our market, they've sort of carried the season. So as we're getting more concentrated, it seems that the US is broadening. What has changed specifically in the US?
What's changed is not just in the US, but it's global, which is we've had very tight monetary policy for several years. And in the last 18 months or so, we've had quite significant policy loosening. And so we're moving from a world where the only source of earnings has really been the Mag 7. Rest of the S&P, not much earnings. Smaller mid caps, not much earnings growth. And then same for Europe, Japan. China's a disaster, of course, but there's been no earnings. And now with this rate cutting cycle, we're starting to see the broadening out in earnings growth, and earnings are now really starting to re-accelerate in other sectors in the US, within the large cap space, but then also within small and mid. So this is the key change at the margin, which I think is driving the broadening theme in US stocks and globally.
Do you think that's something that's temporary, or is it likely to be a multi-year opportunity, do you think, Harry?
Well, I think this carries on. It carries on for a couple of years, especially if we're right about this disinflation story, because that keeps rates low, if not falling further, which provides more stimulus and drives this re-acceleration in manufacturing, industrial cycles, in the credit cycle, and eventually in the consumption cycle. So that underpins this broadening of earnings re-acceleration, that theme.
Yeah. Harry, you talked at the top about the ingredients going into the Goldilocks scenario, and we're seeing these signs of a global cyclical upturn. What's the single most important factor that you're paying attention to or watching, or that's driving it?
Well, I think it's policy. I think cheaper money, rate cuts is key. The capex coming from AI is key. Capex is going to be adding 1.5%, 2% to GDP in the US over this year and next. So it's a real boost to activity. And there's a lot going on in the AI capex. You're drawing on quite a lot of different sectors of the economy. Non-residential investment spending is just starting to re-accelerate. Construction jobs are now picking up. So, you know, there are feedback loops, positive feedback loops from the capex story in the US. So policy and AI capex is, I think, a key driver.
Yeah. Harry, just to take the other side of the conversation, you know, a good analyst always knows their blind spots and knows the other side of the argument. So how high is recession risk? I'm guessing it's not very high, but what would change your mind? What would see you think maybe this isn't what we think it is?
Well, look, firstly, I think recession risk is really low because the corporate sector is so healthy. Companies are throwing off plenty of free cash, debt levels are falling, margins are really healthy. You don't get recessions when companies are in such a good shape. Recessions are really all about companies when they're overstretched and there's a shock and there's something that causes them to tighten up and cut costs, and that's when you get a recession. So I think that's really unlikely. What are the risks? Well, one of the risks has to be the consumer. And if AI really is displacing labour, then the unemployment rate carries on trending up. And that is something that is quite alarming, especially when you think, you look at the consumer, you've also got quite weak house prices. House prices are sort of flatlining. In some states, they're starting to fall. There are question marks about housing because mortgage rates are still quite high. They're about 6% mortgage rates in the US. So money is a little bit tight for housing. Arguably, the whole housing sector is in recession in terms of activity. But falling house prices and negative wealth effects, you've got to worry a bit about the consumer, especially if they're starting to feel like their job is less secure. And then you can start to, if you want to get really bearish, make an argument for a higher savings rate. The savings ratio in the household sector in the US is pretty low. And maybe they want to boost precautionary savings, and that would be a source of weakness in the economy. So that makes us a bit nervous. Consumer confidence is weak. Delinquency rates in the household sector are starting to pick up. So there are little pockets of stress. If you want to get really bullish, you just argue that, well, you're going to get more cuts, and the corporate sector is healthy, and so you reflate. And actually, if you get enough cuts, you're going to stimulate housing. And so you might get a housing boom as well as a capex and productivity boom. So you can quite quickly get bullish again.
Yeah. So I was going to ask you, so if the consumer is the weak spot, can policy solve for that, or is that a stretch?
Yeah, it's a good point, isn't it? Because, of course, what we've got is not really a demand problem. We've got a supply-side technology shock. And you would argue, well, rate cuts are not going to be as effective in restoring demand in that scenario. But I would say actually when you get the rate cuts, you get asset prices up, improve liquidity, so you get wealth effects from the equity market. You also stimulate the credit cycle, which is just starting to reaccelerate. So bank credit in the US is picking up. So there are other things to drive growth, at least for now. So yeah.
Yeah. Harry, you've talked a couple of times, touched on it, disinflation and the potential for it to surprise to the downside. What is happening in the US labour market? I was looking at some data last night. People, particularly at the top end, are losing confidence about being able to find a job if they lost a job in the next 3 months. So it is real. And also, what does it mean for asset allocation?
Well, like you say, there's a lot of stress. We've just had one of the biggest downward revisions, the annual revisions in the labour market in terms of jobs since the GFC. So this is jobs aren't employment's not growing in the US. The annual growth rate is 0. So there's no growth. The employment to population ratio is falling. So employment's not keeping up. It's not a net immigration story. When you really step back and look at the picture, it's actually falling employment relative to the population. And people are discouraged and they're leaving the labour market. They've stopped looking for work. And people are working more part-time because they can't find full-time jobs. So there's underemployment as well. And that, I think, is a key part of the disinflation theme. So it generates weaker wage growth, which drives services inflation lower. Services inflation now is pretty soft across all the categories of services, all of which encourages, I think, the Fed to keep on a loosening path. We're priced for 2 this year and another one next year. I wouldn't be surprised if we price in a little bit more. Right. But to your question, what does it mean for asset allocation? Well, I think what it means is more stimulus in the world. A weaker dollar. EM does very well with a weaker dollar. Earnings in EM are beginning to reaccelerate as they are in Europe and other parts of the world. So it's more stimulus, it's more of the broadening theme. That's the answer. So have a little bit of AI exposure, sure, but I think have smaller mid caps in the US, have Europe, have emerging market equities as well.
Yeah. Harry, I have wanted to ask this question of someone for quite some time. As I was coming up and studying economics, I was always taught that demographics would be a problem, as in, the world, the aging population will age out of the workforce and there's going to be a productivity challenge and decline. And now AI has come along and seemingly can fill that gap and solve that problem. Where are we on that spectrum as we move through time? I'm sure you heard the same arguments when you were coming up as well.
Yeah, well, it's different for different countries, isn't it?
Right.
You look in Japan, you're about to have one of the biggest deflationary shocks emerging in Japan. The working age population is shrinking at about 0.5% a year. By the end of the next decade, it's going to be shrinking by closer to 2%. So it's an enormous contraction in the working age population. And I think that's deflationary. I think that's going to it is causing arguably problems in the Japanese bond market with the back end really blowing out. So, when you've got a debt ratio of 200% of GDP at the government, you've got to start wondering if any of that money is going to be paid back when you've got fewer and fewer people. So there are interesting themes in places like Japan. The US has got a better demographic profile. Yep. there's actually a little bit of growth in the working age population. It's not going to be huge, but at least it's positive, because in places like Germany and Italy, it's really very poor, like it is in Japan and China. So it's a mixed bag. It depends a little bit on where you look in the world. But I think, if anything, it contributes to the global disinflationary theme. We've got disinflation when you look, wherever you look, whether it's the oil price, whether it's China exporting disinflation to the rest of the world. AI, of course, is a big part of that.
Yeah. Let's pick up that thread on AI, and particularly the SaaS apocalypse that we've seen recently, or the SaaSica, whatever you want to call it. Is it a buying opportunity? Are people too early? Are they too late? What's your thoughts?
Well, there's no doubt in the near term, this part of the equity market is heavily beaten up, the software names, and very deeply oversold. In fact, on some of our indicators, we've got very strong buy signals, very rare strong buy signals. So I think there's a good argument for a bounce. There's also a lot of downside put protection in portfolios in these stocks. So there's panic, and that's usually a good time to be getting involved. I wouldn't be surprised if we get a little bit of a bounce. And we go through chapters in markets, don't we? We go through phases of panic, phases of euphoria, and I think we're going to start to get a bit more optimistic about life, probably in that part of the market, at least in the near term.
Yeah. Harry, you touched on it earlier, some of the areas where you're constructive, small and mid caps, Europe and emerging markets. Geez, haven't emerging markets done really well in the last 6 months?
Yeah.
If investors could only pick one of those, though, where do you think? $1 million question, where's the biggest upside?
Yeah, great question. Look, I think, this is very difficult, and it depends a little bit on your time frame, but I really like emerging markets because this is an equity market that's basically gone nowhere for a very long time. It's very cheap. There are a few EM countries where they're a little bit more expensive. Certainly China, India, I think Czech Republic is quite expensive, but basically most of them are 15 times forward earnings or cheaper. Yeah. So it's a cheap part of the market, and if you look at the forward earnings, they're beginning to reaccelerate. So we really like cheap indices where you're beginning to get an earnings reacceleration. You're much more likely to get a re-rating, I think, in that environment. Plus, if our disinflation dominance theme is right, and we do get more Fed loosening, then you're probably going to get further weakness in the dollar, which adds another layer of strength, I think, to the outlook for EM equities. So we really like that. We'd stay away from China or keep quite a low weighting in China in that context. China's an interesting play on AI, a cheap play on AI.
Yep. They've got the power source, don't they? Yeah.
They got cheap energy. There's plenty of positive things you can say about China. I would say, though, that they're in the midst of an ongoing balance sheet recession. They've just had the biggest asset price bubble in modern history, and it's deflating. Real estate activity is falling very sharply. Households are beginning to deleverage. The demographics are terrible. The imbalances in the economy are enormous, with a very large investment share of GDP that's now falling. So there are all kinds of issues, and I think you could argue China in many ways is uninvestable. You've just got to be quite selective about where you put your money. So cheap AI, sure. Other parts of the market we're a bit worried about.
Yeah. Harry, before we get to some rapid fire questions, I just wanted to ask about bond equity correlations. They turned negative again last year. What does that mean? What are you seeing there in terms of risks and opportunities?
It's a great question, isn't it? Because you get a positive bond equity correlation usually when markets are worried about inflation. Yeah. And it makes sense, doesn't it? You worry about inflation, bond yields back up, so bond prices are selling off, and that upsets the equity market. So equities also sell off. That's the positive correlation. And when you flip back into negative correlation like we have over the last year or so, it's really the market saying, we're not worried about inflation anymore. We're now focused on disinflation as the key theme. So it confirms what I was describing earlier, that this is now the story in markets. And with that flip into negative correlation, we've also been seeing the curve steepening. And it makes a lot of sense, doesn't it? When you're worried about inflation, you're also going to be worried about tight money. And that usually flattens and inverts the curve. When you're thinking much more about disinflation, the curve steepens up, which is what we've been having. And with that curve steepening, you get stimulus and you get growth in money supply and growth in the credit cycle. So disinflation, cheaper money, stronger growth. That is the economic macro regime that we are in now. And it confirms, I think, a lot of what I've been describing about broadening and stimulus and global growth reacceleration. So it's a big tick in the box for the view.
Yeah. Harry, rapid fire round, short punchy answers on this one, if I can squeeze them out of you. First up, gold or oil, which has more upside?
Oh, it depends on the time frame, but I would say oil when you're looking out multi-years.
Okay. Cash or high yield? What's the better risk reward?
There's always time frame, isn't it?
Yep.
High yield spreads are super tight, so we're a little bit nervous on that. I'd have a little bit of cash and try and buy a dip in risk.
Very good. I think I know the answer to this one, but we'll fire away anyway. India or China? Where would you rather be long?
India, long-term growth story, and China's a disaster.
Good demographics as well, as we were talking about earlier.
Absolutely.
Yeah. The euro or the yen, which strengthens first?
Oh, the euro, as we get economic momentum coming back into Europe, and the yen, I think, it's trending down, goes lower. Dollar yen is very oversold at the moment, so lower yen.
Yep. Big one here in Australia, private credit or public credit, which worries you more?
Private credit or public credit in Australia?
No, I'm just saying private credit is big in Australia at the moment because we've just had an ASIC review, which is our regulator.
Yeah.
So, but no, more broadly, private credit or public credit.
Yeah, private credit is a little bit worrying, isn't it? Yeah. Because you've got a lot of investment into AI business models, perhaps over investment, and there's a lot of capital that could get destroyed if you end up with a lot of supply, margin squeezes because you're racing to the bottom on price and so on. So yeah.
Yeah. Harry, that was an absolute pleasure, mate. Thank you for sitting down.
Pleasure. Thank you for having me.
If you enjoyed that interview, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.